about for months now, whether the trade deal gets done with China, whether Brexit is accomplished, and other geopolitical risks have not been entirely removed, but they've eased somewhat, too. Will we see those reappear in the weeks to come?
I don't know. I just don't think the market cares about those things right here. I mean, we've gone through this for 2 years with China, with Brexit for 3 years. I think capital moves on. And capital has moved on in this instance, and you see it in the leadership. The stocks that are at the center of this China storm, whether it's Apple or AMAT or Samsung or Taiwan Semi, are all the leaders here. So clearly the market's focused on something that we may not be.
John Petrides, what's your take on how good earnings season has been thus far and whether it justifies being just a couple of points from a record all-time closing high for the S&P 500?
Yeah, I think with earnings, we're getting what we expected, but it's not as bad as feared. So on all of the cyclical industrials that have exposure to a slowing global economy and that we're basically heading into or near an industrial recession, well, those stocks are getting hit hard. Look at the likes of Caterpillar and look at the earnings on 3M and others. But then you look at, it's not spilling into all the other sectors. The banks have done really well. By and large, the chips have done well. So we knew that there's a slowing economy. We knew that was going to impact the industrials. And the fear was, will it spill into other sectors? And by and large, you're not seeing that yet, which is why stocks are rallying.
John, what's your take on next week's Fed meeting and how important that is to see the rate cut that the market expects?
Yeah, I mean, it's all going to be, let's see what the job numbers are going to be next Friday. I think all eyes, again, should always be on the wage data. The last month it dipped below 3%, which takes a lot of pressure off the Fed to not raise rates. It gives the Fed ammunition to raise rates and continue to be putting the gas on quantitative easing because inflation really isn't transparent. It's not happening throughout the economy. So it gives the Fed a lot of breathing room to force more stimulus into the market.
John, your credit team is noting that high-yield bonds have rallied for 11 straight days, the longest winning streak since April. What do you make of the move on these bond yields?
Yeah, so the good and the bad. The good is that the credit markets remain open and companies have access to capital, and that's a tremendous sign because if we were heading into recession or in recession, credit markets tighten, companies get shut off to credit, the capital markets, and bad things happen. But on the bad side that investors have to be careful of is if they're stretching for yield, they're going down the credit quality. So, if high yield is rallying, that means the lower quality portion of companies that in a recession could be in trouble. Investors are picking up those yields, and they're taking on more risk to pick up yield, and that's where you have to be careful in a downturn.
Mike, I want to pivot and go back to Amazon. What a stunning intraday recovery. I mean, we're talking 9%, not the couple of percent we saw for Cat in the middle of the week. This is huge.
It was huge. It was a kind of a compressed reaction because often you do get a shakeout on earnings from Amazon and then gradually it rebuilds. I think part of this is the peak in the stock is $2,050. Okay, so in other words, the stock didn't come into this report built up on a lot of aggressive expectations with people essentially betting on it was a momentum play. And so I do think you had sort of time and space to sort through the fact that this was not necessarily a completely out of line report. Then you have to filter in the idea. It's a relatively firm tape. I think that Amazon is known for lowballing the fourth quarter revenue estimate. So all that stuff fits together, and it shows you that the market itself is kind of imperturbable right here.
Also on the call, they were making a big play about the investments that they're making and that there's an immediate cost to making those investments, but then in the long run, they pay off, and Amazon has the track record to show that.
The interesting thing is that Amazon has had to send that message and get it across for 22 years since they've been public. And they repeatedly have to do that because after a while, it looks like they're in harvesting mode and investors think, this is a free cash flow story. Then they have a little bit of a panic when it's an investment phase and they have to kind of come back and warm up to the story again.